All right, let's talk about something you've probably heard thrown around a lot, investing versus trading. Now, they both happen in the stock market, sure, but they are fundamentally different roads to take. In today's explainer, we're going to break it all down so you can really get a handle on these two approaches. Okay, let's get into it.
So picture this. When you think stock market, who pops into your head? Is it someone like Warren Buffett, the ultimate patient, long-term wealth builder who famously buys and holds forever? Or is it the crazy, fast-paced, high-stakes world you see in The Wolf of Wall Street? I mean, these two extremes really nailed the two philosophies we're digging into today, the investor versus the trader.
Okay, so here's what we're going to cover. We'll start by looking at these two very different paths. First, we'll dive into the investor's mindset, which is a lot like planting seeds. Then, we'll flip over to the trader's world of catching waves. After that, we'll put them right next to each other, head to head, and finally, we'll get into why one of these paths, patience, usually comes out on top.
First up, the investor. And honestly, the best way to think about an investor is like a patient gardener. You know, they're not in a rush, they carefully pick their seeds, which in this case are companies, they plant them and they nurture them for a long, long time, fully expecting them to grow into something big and fruitful down the road. It's all about that future harvest.
So if we were to get technical about it, what is investing? Well, it's the act of putting your money to work with the hope, the expectation really, that it's going to grow over a long period. The two key words you got to remember here are appreciation and long period. This is not about making a quick buck. It's about buying something you truly believe will be worth a whole lot more way, way in the future.
So what's in the investor's toolbox? Well, it's all about that long game. Their goal is to build wealth, nice and steady, over years, even decades. And to do that, they use something called fundamental analysis. Think of it like being a detective. They're digging into a company's health, its books, its leadership, the whole shebang. They'll use stocks, sure, but also things like ETFs and mutual funds to spread their money around and not put all their eggs in one basket. But really, the most important tool is their mindset. They see themselves as owners, buying a small piece of an actual business.
Okay, now let's flip the script completely and talk about the trader. If the investor is a gardener, the trader is a surfer. They're not trying to plant a forest. No, they're out on the water, scanning the horizon, trying to spot the next big wave, a short-term jump in price, ride it for as long as they can, and then hop off right before it crashes.
And yeah, the official definition tells you everything you need to know. Trading is all about frequently buying and selling. The whole point is to make money off of those short-term price swings. The focus isn't on the long-term health of a company at all. It's on capturing quick profits from all the noise and volatility the market makes every single day.
The trader's toolkit? It's totally different. It's built for speed. Instead of digging into a company's financials, they use technical analysis. That means they're staring at charts, looking for patterns in all those squiggly lines to try and predict where the price is going to go next. And they use tools like options and futures to make bigger bets on those moves. You see, the mindset shifts completely. It's not about ownership anymore. It's about pure speculation. You're just betting on which way the price will wiggle.
All right, so we've got our gardener and we've got our surfer. Now let's put them in the ring, head to head. We're going to compare them on the three things that really separate them: how they see time, how they handle risk, and the kind of mental game they have to play.
This right here, this is probably the single biggest difference between the two. Investing is a marathon. We're talking years, even decades. The whole philosophy is about time in the market. The idea that the longer you stay put, the more time your money has to grow. Trading, on the other hand, is a series of sprints. Days, weeks, maybe a few months. It's all about timing the market, trying to nail that perfect moment to buy low and sell high.
And just look at this. It really puts it into perspective, right? The investor is thinking in terms of college funds and retirement. The trader is thinking about, well, next week. They're playing two completely different games on two completely different clocks.
Okay, what about risk? Because there's always risk. How do they deal with it? Well, an investor's whole game plan is to manage risk. They spread their money out across lots of different things, diversification, and they just hold on tight when things get rocky, trusting that the market will eventually go back up. But a trader embraces risk. They know any one trade could blow up, so they use tools like stop losses to automatically get out if a trade goes south. They accept the chance of losing money fast for the chance of making money just as fast.
And this last one is huge, the mental game. Both of these paths take a ton of discipline, but it's a completely different kind. For an investor, the big enemy is fear. It takes serious guts to not panic and sell everything when the market is crashing.
For a trader, the enemies are fear and greed. It takes ice in your veins to cut a losing trade without hesitating, and to take your profits without getting greedy for just a little bit more. In both worlds, your emotions are usually your worst enemy.
So we've laid out the two paths, the patient gardener and the thrill-seeking surfer. And while sure, you can be successful with either one of these paths is just way more reliable for most people trying to build wealth over their lifetime. Let's dig into why.
So why does the slow and steady approach usually win out for most people? Well, the investor has some secret weapons on their side. The biggest one is compounding. It's like magic. It's when your earnings start making their own earnings and things just snowball over time. But it only works if you're patient. It's also just cheaper. Trading a lot means tons of fees and taxes. Investing is also just less stressful. You don't have to be glued to your screen all day. And finally, history's on your side. Day to day, the market is a roller coaster, but over the long run, it has always gone up.
You know, there's this great quote that just perfectly sums it all up. The stock market is a device for transferring money from the impatient to the patient. It basically says that all that frantic energy, all that trying to time the market perfectly, it often just ends up making the patient people, the ones who just held on, richer.
So to wrap this all up, I want to leave you with one final thought. Think about the market as a massive ocean. Investing, well, that's like building a big, sturdy ship. It's designed to handle storms, to sail across that whole ocean over many years and get you safely to a far-off destination. Trading, on the other hand, is like trying to ride one perfect wave. It can be an incredible thrill, for sure, but it is incredibly risky and it demands perfect timing. So the question you have to ask yourself is, what's your destination? And are you trying to build a ship, or are you just trying to ride a wave?